Well, I'm going to start the meeting off. First things first, guys, I just want to tell you where Gelt lands in our lender bucket. So I'm going to go ahead and share my screen so you guys can see. The reason why we brought Gelt in is because they are another one of those small balance commercial bridge lenders that fits a real tight niche. Just like we had Kirkland on last week, these guys are in that same niche. So we're trying to kind of fill that right now because it's been a void for us. You can find them in the commercial bridge bucket. So if you have access to this, it's the commercial bridge bucket. If you guys are just using these conferences and then the emails that I send out and building your own list, go ahead and put it in the commercial bridge area, okay? But here they are. We're going to have Michael Kelman on today as well as Ross. You guys want to say hi?
Hello.
There they are. And we're going to let Mike go ahead and present now. So Mike, thank you so much for hopping on, brother. We've sent a couple deals over to you. I don't think we funded anything yet, but that's okay. Eventually we will. And Mike, I'm going to let you go ahead and why don't you just introduce yourself first off, give us a rundown of who Gelt is, kind of maybe how you guys started, how you guys operate, and then we'll dive into your products and get into the Q&A later on.
Absolutely. Thank you. So my name is Michael Kelman. You can reach me anytime here, obviously via email or phone. Very easily reachable. Our specialty at Gelt Financial, I would say, we're a private boutique lender. So for us, we're lending on commercial real estate, which consists of single family investment properties, mixed use, multifamily, retail, office, gas stations, car washes, mobile home parks. Some flex space, some light industrial, things like that. Actually, the owner and principal, Jack Miller, who founded Gelt Financial, just stepped in here. Jack, slide into the view a little bit. So,
no, guys, I'm just screwing around. How you doing?
Hey,
but
what's up,
yeah,
brother?
so Jack started the company. What's the matter?
Nothing. I'm trying to get in there.
Anywhere you want, go sit. Go sit.
If you want to sit down, you can.
Okay. No, but I'm just giving them my spiel, who we are. So we're really a direct lender, and we're lending on commercial real estate, closing in an LLC where we are, in first lien position. Our collateral is valued $250,000 or greater, and we lend up to 65%. Some unique things about us are we do not require a minimum credit score, and we don't do any third-party appraisals or require them on any loans. We do our own valuation. Ross, actually, our head analyst here, does the valuations for us. We have software, we have Jack's experience, so we're going to be conservative. We're going to come up with a value. We'll explain how we come up with those values, and we will potentially lend up to 65% if it has the rental income and the comfort levels we need to make sure it can debt service. And our rates are in that, say, 12 to 14% interest only range.
Okay,
so
right.
Our specialty really is, helping clients who need to close quickly, whether they can or can't go to a bank. Maybe the deal fell apart at another lender. Maybe there's issues with the property where they need to close. Maybe it can't go to a bank. We're very successful helping clients with foreclosures or bankruptcies or go ahead.
I apologize. Pleased to virtually meet everyone. I popped in and I got to pop out. I have someone waiting in someone else's office, but I wanted to thank everyone for being here today. We're excited about dealing with you. And I don't know if Michael said, I always tell people the number one thing, and I don't know if it's the number one thing differentiator with us is we don't sell our loans on the secondary market. We're not selling them to Wall Street or securitizations, or there's no outside investor pool that if they stop buying or the market changes, or we do all of the underwriting in-house. So when you speak to us, you're going to get a very quick, it could be a quick no, and don't be mad if it's a no. To be honest with you, there's more no's than yeses in this business, but you'll get a quick answer and a quick execution.
Right.
Amen. That's what we like to hear. We like quick answers because we don't like going back and forth for a week and a half, right? Just to see
no. If we like the deal, we'll jump on it very quickly. We can close it very quickly. And we're, not a night goes by, and I'm talking 7 nights a week. I'm not getting emails or texts from brokers or borrowers. We respond evenings, weekends. It doesn't matter.
Yep.
Fantastic, brother. Thank you so much.
Okay,
man.
guys, I gotta run. I'm looking forward to working with you guys in the future. I gotta jump to another meeting. Take
All right.
care.
Yes, sir.
But as Jack mentioned, also what's important is we service the loans internally also. So, loans we close, we keep them in-house. Borrowers make their payments to us, clients, brokers, they can always call and talk to us about the loan. I have a client, a broker that I'm very good friends with, he's done a lot of deals with us. And they use us for a short-term option, right? So we're lending anywhere between 6 months to 5 years. So he comes to us, he gets the payoffs from us, and he takes his clients out of our loan as well. So he brings them to us on a purchase with some rehab, and then he'll take us out with a conventional loan. So he's doing the deal both times. And you have to be a good broker to do that. If you forget your client and you don't mark calendars, you're going to lose that refi. You know what I mean? But ultimately, we are a short-term solution, right? So 6 months to 5 years, interest only. That's our deal. We'll keep those loans in-house. And a lot of times, deals with us are closing in a week to 10 days, possibly sooner, if they've fallen apart at another lender. So we like a lot of the deals where we have good collateral, we're low leverage, and then the borrower will look at them secondary, right? We'll look at their tax returns and bank statements and credit. But first, we're going to focus on the real estate.
Okay.
And
How do you
very
guys
creative.
feel about how do you guys feel about assisted living, like the
No. So nothing specialized, assisted living, churches, religious facilities, any kind of very, very large single tenant building, like a 40,000 square foot single tenant office building is not a good fit, or retail. We like properties that are easily rentable. And to talk on the assisted living, just to give you our view, I just had a great deal today. That was a 3 million purchase. They were asking us for a 1 million loan amount. They're putting 2 million down. Who would say no to that deal? But we passed because it was going to be a rooming house. That's the way it's operating now. That's the way it's going to operate tomorrow. And it's bringing in incredible money. Don't get me wrong, but we can't operate that property. God forbid we have a bad operator who doesn't pay us. We have to go evict all these people living in this house. And so that's why personally, we just don't like dealing with that kind of an asset, if you will.
I got you. How do you guys feel about rural assets?
Sure. So for us, what we look at is this, we lend in 38 states nationwide, but we like the property to be in a city with a population at least 50,000 plus. So we understand if it's like in an MSA that's larger, but it has to be very close, like, Snellville in Georgia. Snellville's small, but it's in Atlanta. You know what I mean? So that's a deal I literally looked at today. So that's what we're looking at, but we need it to be, decent population for sure.
Okay, roger that. Now, how do you guys work with brokers in terms of the points and fees that we're allowed to throw on the HUD?
Sure. So on all our loans, our pricing, I guess, economics or schematic or whatever you want to call it, it's the same. We charge a 3% origination fee, a due diligence, an underwriting, a legal fee, internal appraisal, and an inspection. Now we charge 3% on all our loans. You can charge 1 to 3% as well if your client agrees upon that. We don't pay out any money, but what we do is we put your fee on the term sheet that we give to you to give to the client, and we make sure your fee's on the HUD and you get paid on at closing. And please, if there's a deal that's smaller and you've been able to sell a higher origination fee, we would like to match your fee. That's the only reason. We're typically the ones paying, right? If it's a purchase, I don't mind. Let me start over. I'm sorry. If it's a purchase and it's coming out of the client's pocket and you're charging 5% and I'm charging 3%, I'm fine with it. But if we're providing it on a refinance, we want to at least earn 3%. You can earn 3%. If it's more, we want more.
Okay, got it. And you said you were running credit, but then I'm seeing something on here that says that no credit run.
So we do not require, let me say this, we have no minimum credit score requirement. We do require a full credit report upon submission. I'm dealing with a client right now, borrowing $1 million cash out. He has mortgage rates on every single property he owns. Still doing the deal because I'm in it for like 40–50%. It's in South Beach, beautiful property. But I was concerned. We almost didn't do the deal because he's got terrible credit with mortgage rates. However, we're in the deal good, our basis is good, it's in our backyard, we made the exception, we're still gonna go forward with the deal. But had this been in New York, a much harder state to foreclose, we may not have done the deal, or we might have to restructure the security for us, maybe like put it in an LLC that we have control over, something like that.
Okay, right on. Does anybody else have any questions so far for Mr. Michael or Ross? Ross is their lead analyst over there. He's the one analyzing the loans. And where they don't do the appraisal, Ross, I'm assuming you're looking at values yourself?
Yeah, I call Ross the deal killer, all joking aside, but you know, things that I may like, once Ross gets his hands on it, you know, and again, Ross has a tremendous background in this real estate side. He's been working directly with the owner of Gelt Financial, who's writing the check. So he's been trained to mimic what Jack wants to lend and what Jack wants to buy. So, you know, what's nice is, you know, if you have questions and you want to know how we value stuff, you know, Ross is the greatest person to speak to get an idea where you think you're sitting with a deal, what you think we can lend. And that's how it gives me, literally, you can send me your deal and I will have an answer for you in probably 5 to 10 minutes with what we can do. And you don't even have to give me anything but an address. And I'll tell you where I think we can be based on, you know, what we find.
Who is lending the money? Is Jack representing a family office, or what's the story with that?
We use the capital right off our balance sheet. We have a very large portfolio of real estate that we own and manage. Plus we have the debt that I personally do the debt here for Jack. You know, I originate like I said, 99% of all the debt here. And I've been here for a few years. So I've been very successful, you know, putting together a lot of loans here, and we service them. And then we have our own property management and loan servicing. We service loans for a lot of lenders, you know, because we have a complete department that's just set up for loan servicing. So we have a whole bunch of different little buckets, if you will, of debt. We have a debt, loan servicing, property management. We buy and sell, obviously, our own real estate as well. So we're using capital off our balance sheet, in other words.
Mark, did you have a question?
I did. So what would you lend to either a nonprofit company or where the tenants are nonprofit?
We do not lend to nonprofits. It must be an LLC or an entity for profit. But I don't care if a tenant's a nonprofit, assuming that I'm comfortable with what the lease is. And, you know, again, if it's a heavy, like, religious facility or something like that, you know, we don't want to kick out a tenant like that. But I've lent to where tenants are a church, and that church is a nonprofit, and it's in a nice retail center, and they're great tenants, and they pay their debt, and they have great borrowers. I love it. Well, I just don't want to get caught up where we look like a bad, you know, lender trying to evict good people. Like, that's really, it's all a personal thing like that.
Right. No, it's nothing that's a religious institution or,
Yeah.
okay. I have a couple of scenarios.
Yeah, for instance, Mark, we once did a loan. Yeah, we did a loan, Mark, where we had a office setting, and one of the tenants happened to operate a charity, and it was a nonprofit, and they took up like 4,000 square feet. It was a beautiful tenant, and they were paying market rent with a lease, and we're fine with that. That's fine.
Thank you.
Absolutely.
We have a scenario right now Justin's working on, and the debt service issue is a problem with most lenders. Justin, do you know if they're going to be willing to just take a bridge on that to purchase?
Sorry, I had to get off mute. Yeah, I think they would.
Okay, right on. So that's basically a vacant 6-unit parcel, and it's in San Diego. It's like what was the purchase price on that, brother?
Like 2.7 million.
2.7, yep. And it's vacant though, and it would be a purchase.
So a situation like that, you know, just talking about the deal itself, we don't lend in California, so I couldn't help with that one. But that's okay, but just talking about that scenario. So for me, what I would say is, one, maybe we can help if they have other collateral, right? If we could cross collateralize with another property, sometimes we can do that to get comfortable with the deal. Or sometimes maybe they can bring on an investor who has some property we can use as well. Or they can put enough money down, maybe they can get a seller to hold a second, and we can be lower leverage, right? So again, in a 9-unit, if there was some value add aspects and it was in a beautiful location and I saw the possibilities of a very strong, successful asset, I would be happy to get involved in that deal at a lower leverage basis, allowing possibly secondary seller financing or other collateral. I just don't want to be caught in a property that needs a lot of work, and that's not really our deal. We don't know heavy rehab. So that's kind of our issue is we just don't know the big rehab. So much could go wrong, and it's, we don't claim to be fix and flip lenders.
What's your max seller carry on a note?
Well, good question. I don't have a max. I mean, there's been deals where they've put 50% up and there's not been one penny from the borrower. And I'm okay with that as long as I'm lower leverage. I don't want to be at 65% with the seller bringing in 35% plus closing costs, unless there's really a true like 1031 exchange reason, or, again, it's hard to say I don't want to be because I don't know the deal, but if you show me a property where I love the location, I love my basis, then I don't really care, right? I want to make sure that I'm not over leveraged. That's the truth. I'm trying to prevent somebody putting me at 80%.
Gotcha. I'm reading here debt service coverage is a thing with you. However, you're a bridge lender, right? So
yeah, so
can you bring some?
Yes, yeah, no, you're right. So here's what I would say to that. If you bring me a property that's completely stabilized and you're asking me to get to the max leverage that we offer, which is 65%, and you have your tenants already locked in leases, so there's no upside, was my point to that. I don't want to lend that client more than that property can afford unless I have a very strong borrower. The reason being is, I don't like clients going out of their pocket, to pay my interest rate because my rates are higher, right? I'd rather just be lower leverage and let the property cover the debt. But to go backwards, if you said to me, hey, Michael, I have a 9-unit, 6 units are occupied, I need 65% of the purchase price, we have a little value add aspect, I may be okay with it not debt servicing, and assuming that we have minor, rehab to get the other units occupied, and we have a decent borrower who can cover the out-of-pocket expenses. It's just, if you're asking me for $1 million loan amount and they're coming out of pocket $4 or $5 grand a month, I'm not comfortable with that. That's the reason.
What ratio would you look for in a stabilized asset?
I would say just cover the taxes and insurance and our payment. Just 1%. I really we don't have any set numbers. I just looked at a deal now where a client's coming out of pocket like $1,000 on a $900,000 loan, and we're putting that out of pocket money to the back of the loan. So by the time they pay us off, we'll collect it then. So my point is, we're very flexible. We want to do deals.
I got you.
We don't want a borrower in over their head. I don't want a borrower with terrible credit, with no tax returns, no bank statements, to be in a loan where they have to come out of pocket.
Understood. All right, guys. Cyrus, Mark, Eric, anybody else have any other questions before we get into maybe reviewing some scenarios? Leave it open for you guys just for a second.
Just
Great.
quick
Anybody have
question.
any?
You mentioned, sorry,
Yeah, go.
you mentioned you don't lend in California. Where else do you do not lend to?
We do not lend in California, Oregon, Arizona, Hawaii, Alaska, Minnesota, Idaho, Vermont, the Dakotas. I think that's it. Oh,
Where did I
Utah.
see that on your website? I saw it
It's on our
somewhere.
application. It's on my tear sheet as well. I don't know, is it on the website, Ross? Yeah, it should be. It should be on the website, maybe in states. I
Oh,
don't
you know
but
what?
it's-
I think I saw it in your email.
Okay.
We got to put that on the sheet for sure.
Yeah, so I actually have, I can send you, like my tear sheets I have a whole bunch of different tear sheets, because, we do debt for homeowners associations, condo associations, foreclosure bailout, bankruptcy exit, things like that. So I have specific tear sheets. Actually, Ross made them for me, so I can share them with you, and that'll also give you information on things we don't do.
Perfect. Yeah, when we get off the call, just shoot it over. I will send it off to everybody that's on the call and who's not on the call as well. And so everybody will have that.
Absolutely.
All right, guys, I don't really have any other questions for them so far. Everything sounds pretty straightforward, straight up commercial bridge lender. I saw you guys do some environmentally hazardous stuff that a lot of guys don't, like car washes and gas stations. Is there a reason
Yeah.
why you guys are okay with those versus other lenders right now?
Yeah, so funny enough, we actually closed the a car wash deal this year. We like the basic information, make sure it's a clean environmental. But this was I believe it was in North Carolina. North Carolina, beautiful car wash, the kind where it's just bays with like the pressure washer, like a whole bunch of different bays. Beautiful deal. We were 65% leverage, strong market. It was a purchase. We had a clean environmental, great deal. Car washes, we like. Sorry.
Would you require phase 1 or phase 2 on
Yes,
something like that?
Yes.
Okay.
But the seller had it. I guess they have to renew every year to stay in business. Like there's a certificate, so the seller had everything.
How do you feel
Yes.
about foreign investors?
Oh, we love them. I'm fine. I don't care. I have no issue
What
with that.
about ITIN,
That's
ITIN
fine.
investors?
That's okay.
Okay.
The only issue for us, is we do background checks. And so we want to make sure we don't have any bad borrowers. We've had borrowers who have had criminal backgrounds, that's okay, but no financial crimes, no terrorism. I mean, just to say the obvious, you know what I mean? So we do run them through a website for every loan, and we've turned down quite a bit of deals because they come back in this findings.
Okay, I hear you. All good. There we go. I see your area there. I'm gonna fill that out.
Yes.
Thanks for sending that over. All right, guys. Any other questions before we let Mike go? And Mike, tell us best way to submit a deal to you. What do you like to see initially? And then, let's just say you get a good scenario. What's the next steps normally to get the deal going?
So we're very easy, if you want to call me, that's great, or email me, right? Fastest is email, because even at nighttime, I can't help myself but review my emails, and I'll answer you too, and I don't mind it. So, I always tell people to email me because I'm always on the phone during the day. But again, basic information, just, hey, Michael, I got a purchase, here's the address. They're looking for this loan amount. This is a little background. Here's the income. My wish list would be, personal financial statement, copy of credit, and, the purchase and sale agreement, or, if there's a rent roll, or just give me a little bit of information. But anytime you submit a deal, again, you can just simply give me a quick little email, and I have no problem saying, hey, send me this or that. We're not formal where I make you send a complete package before I speak to you. I'm not like that. You can simply call me, see if something's a good fit, pick my brain. I'm very comfortable working like that.
All right, so let's say a deal's a good fit. Let's just say it's just like a normal, like multifamily deal. You say it's a good fit. Do you issue a standard term sheet or?
Yeah, so here's what happens. So first, I ask for certain documents, personal financial statement, credit, purchase and sale, whatever. So you gave me everything I need. Then I'll say, hey, we have a GELT application. It's an Excel spreadsheet. Fill out the personal financial statement and the intake tab, send it back. Then I provide you with a term sheet. It'll list all of our conditions, all of our fees. I give that to you. You can submit it to your client. You can call me with your client. Hey, Michael, I got the client on the call. Let's go over it line by line. This way there's no misunderstanding anything. I'm very comfortable with that if you want. And then the next step would be to sign the term sheet, and we have an upfront due diligence fee. And everybody has their issues with paying upfront fees. I'm very sensitive to that. But for us, that is basically a deposit where now we're going to order title from a company of your choice or your borrower's choice. We're going to order insurance. We're going to clear the conditions. We're going to set aside the dollars you need, and we're going to move very quickly. So, and order the inspection, right? So for us, what happens is, we're not charging a third-party appraisal fee of a few grand, but we're charging this small upfront fee to lock the client kind of in.
What is the due diligence fee regularly?
Starts at $1,500.
Okay.
So my $1 million deal I'm working on right now, they sent us 5,000. And we ordered title, insurance, we did all our work. And so again, if a client has issues paying those upfront fees, I get it. They're probably paying another lender 3, 4, 5 grand for an appraisal upfront before they know if they can.
No appraisal though.
No.
So no hang up on appraisals, which is good. But you guys have your internal team. How often?
I was just gonna say, we collect $500. That's the set fee regardless of the value of the property. If it's 100 or 10 million, it's a $500 fee we collect at closing for our valuation.
Okay. How deeply do you underwrite these before we start taking due diligence fees? And Mark, we'll get to your question in a second. Because obviously,
question.
right, people pay for appraisals and then it's like, well, you know, it's a gamble to the borrower every single time. So I want to know,
Yeah, no.
how confident are you before you start issuing these terms and collecting?
No, that's a great question. So I would say this, we are over and above in our valuation. We are very conservative in a good, a healthy way, but we will not issue that term sheet unless Ross gives his blessing and then Jack signs off on that blessing. I will not submit a term sheet to anyone unless it's gone through Marcy, she's the vice president at Galt Financial, does all our closings, Jack Miller, and then Ross. So that's our little procedure is we get together. Of course, I come up with my own value. I do my own due diligence in 5 minutes. And then my process is I go to Ross, who sits next to me, and I say, Ross, here's what I got. Here's what I'm working on. Dig in. And I don't tell him anything. I let him figure it out on his own. And then we meet together. I tell him my cons. And you know what I would love to do, John? I'll send you a little back of the napkin, if you will, of what we do. So you can say, oh, these guys are the real deal. Look at what they're doing. We'll do a liquidation analysis. I mean, we really go very, very in depth.
Okay.
You know what I mean in our approach.
Yeah.
So I would say that once that's completed, which again, it sounds like a lot, but Ross is able to do this in half hour, an hour, then we'll be able to issue that term sheet and provide a dollar amount that we can stick to. I want to say this, it just happened on a live deal. We issued a term sheet at 450. We thought that we were at 65% of value. They told us it was 4 tenants. Here's the rental income. Everything was great. We get the inspection back, and our single tenant that was paying $7,500 a month rent, where everyone else was paying like $800 a month, the majority of the deal was 4 folding tables and bridge chairs. That was the operational restaurant in Florida paying $7,500 a month. It's
Right.
BS. So that
Right.
immediately was like a red flag to us, and we're not comfortable in the deal. So again, we have to verify, a lot of specifics as well.
Right. And you're sending an inspector out
Yeah.
to take
Yeah.
photos? Okay. So it's
And
internal, it's basically
not-
internal.
not like it's exactly what you said. It's to take photos, make sure it's there, make sure it's decently structured, but it's not like he's going through the attics and things like that.
Got it. All right, Mark, you had a question?
Just a quick one. On the purchase, will you allow owner financing towards the down payment?
Yeah, so we call that seller financing, like a seller second. We're okay with that. Again, as long as we feel that it's a true value, the purchase price, that we are at 65%. In some cases, if your borrower is not bringing any money in the deal, we just lower our leverage. But because we like our borrower to have at least 20% of their own money, if not the full 35. But if you said to me, hey, Michael, the seller is willing to put all 35% down, maybe I come back at 55 or 60% of the purchase price. But to be fair to your deal,
yeah,
if I am very comfortable with my 65% being at market, I'll be fine with that. I don't care. I just don't want to be over leveraged. That's the bottom line.
got it.
So
Thank you.
strong locations, Mark, like a very good location, very strong MSA, I don't care. But where we're stretching to find the value, that's when it matters.
Thank you very much.
Yeah, of course. Thank you.
And no
Thank
land
you.
deals, guys. There's got to be a structure,
Yeah, unless it's in Miami or South Florida.
and they're not doing heavy rehab, so light rehab. So remember that.
Yes. We're also doing bankruptcy exit, foreclosure bailout loans as well, which is pretty big for us.
Yeah, that's probably a pretty big market right now, I would imagine. A lot of loans are maturing and they're not able to get into that longer term financing. It's taking longer than expected. They're in default. So I got you.
Yeah, you're 100% right. And what happened was, let's say a year or two ago, the rates were better. And so they were going into a 1 or a 2 year loan at a higher leverage, right? And now the market's kind of collapsed a little bit. Caps rate came up, values have gone down. They're asking me, a 65% lender, to take out a 75 or an 80% loan. They're going into foreclosure. And so we've been successful with those deals where we're increasing our leverage basis by structuring the deal in an entity that we control. So like a sale leaseback or an equity partnership. We're still
I was going to
helping them.
ask you, so you guys are doing these bailouts via the equity position. So we've been looking for someone like this actually, because we've all been getting scenarios just like that, where they're just not debt servicing anywhere else. They have a higher payoff than anybody's allowing on a loan amount. And so I've been saying this, it's like somebody's going to fill that gap via equity. So give us 50% of equity and I will
Yeah.
bail you out of that loan. And
Yeah.
they're either going to have to do that or put up their own money. Are you seeing these from like REITs or individual investors or investor groups mostly, or?
Individual investors, you know, through brokers, obviously, but just investors. The majority are single family homes, 1 to 4 unit, all residential, not your office, not really retail. It's really the fix and flip guys, the guys who did the fix and flip. They got it stabilized, but now the value's just not there to take the loan out. And so a couple we just recently did, I'm trying to think, you know, we were probably 75 or 80% of the value. We did as a sale leaseback. So God forbid they don't pay us. There's not 1 penny more we have to spend. Just to tell you about a real life scenario, in South Florida, there was a woman who bought a restaurant and we didn't want to do the deal at 65%. We weren't comfortable. We ended up doing the deal at 75% as a sale leaseback. She stopped paying. It went sideways. Was no issue with court. We own that property for probably 75 cents on the dollar. It's already rented out. It's already a very successful transaction. We don't want to do that as a lender, but had we had to go through a year or 2 of court, you know what I mean, in bankruptcies and not earning the rental income, right? Not earning the interest. That's what hurts.
So your equity bail, basically these bailout loans, you're really only allowing those on 1 to 4 investments. You're not going into the commercial space on the equity?
Anything,
Okay.
any type of property, anything.
All right.
It doesn't matter. Even if it's not in default, if you just came to me with a client who really needs a certain dollar amount and it's above what I want to lend, if you just tell me, hey, Michael, I'll be the one to get creative to offer that to you, but I sell it to everyone. I mean, we're 65% lenders. If you want me to go to 75, we'll do it as an equity partnership. We're not asking for anything more. I'm not asking for more interest rate, more pricing. I just don't want to deal with legal. So we step in and we control the LLC and we'll foreclose on ourselves.
Got it. That's actually pretty good value right now. That's like a huge thing that we've been seeing a lot of. So that's actually really great to hear. All right, guys, anybody have any other questions? I think I've stretched it as far as I can go. Any final questions, any final scenarios that you guys have been struggling to fund that you want to bring up to Mike while we got him on the phone and everybody can listen in to how he kind of reviews that deal? All right, that's fine. I'm sure you'll get some scenarios, Mike.
Yeah,
as,
anytime. You can always
time
reach out to me. You know, things may pop up, you know what I mean? I'm always happy to talk.
All right, perfect. All right, guys, everybody, thank you so much, Mike. Thank you, Ross, for being online with us too, brother. And everybody, this is going to get posted up in the community area, so you'll be able to watch the replay, and you have him in the commercial bridge bucket. So thank you so much, Mike. Thank you, everybody, for being on the call.
Of course.
We'll talk to you guys soon.
Thanks for setting it up, John. I appreciate it.
No problem. And don't forget to send me that information you're going to send. I'll
I
blast
will.
it to everybody. All
I
right.
will. Thank you.
All right. God
Thank
bless,
you.
guys. Take care. Bye-bye.